Hello everyone, welcome to week 1 lecture videos once again. In this video, I'll be talking about other special services provided by financial institutions. First of all is reduced transaction costs. Just as financial institutions provide potential economies of scale in information collection, as we discussed in the previous video, they also provide potential economies of scale in transaction costs. By grouping their assets in financial institutions that purchases assets in bulk, such as in managed funds and superannuation funds, household savers can reduce the transaction costs of their asset purchases. In addition, bid-ask spreads are normally lower for assets bought and sold in large quantities. Then maturity intermediation. An additional dimension of financial institutions' ability to reduce risk by diversification is that they can better bear the risk of mismatching the maturities of their assets and liabilities that then can small household savers. Thus, financial institutions offer maturity intermediation service to the rest of the economy. Specifically, through maturity mismatching, financial institutions can produce new type of contracts, such as long-term mortgage loans to households, while still raising funds with short-term liability contracts. Further, while such mismatches can subject financial institutions to interest rate risk that we will be discussing later, a large financial institution is better able to manage this risk through its superior access to markets and instruments for hedging, such as loan sales and securitizations. The next one is transmission of monetary policy. Because the liabilities of depository institutions are a significant component of money supply that impacts the rate of inflation, they play a key role in the transmission of monetary policies from the central bank to the rest of the economy. That is, depository institutions are the conduit through which monetary policy actions impact the rest of the financial sector and the economy in general. Credit allocation. A further reason why financial institutions are often viewed as a special is that they are the major and sometimes only source of finance for a particular sector of the economy pre-identified as being a special need of finance. Policymakers in a number of countries, including Australia, have identified residential real estate as needing special subsidies. Such policies enhance the specialness of the financial institutions that most commonly service the needs of the sector. Intergenerational transfer or time intermediation. The ability of savers to transfer wealth between youth and old age and across generations is also of great importance to the social well-being of a country. Because of this, life insurance and superannuation funds are encouraged by a special taxation relief and other subsidy mechanism to service and accommodate their needs. Payment services. Depository institutions such as banks, building societies, and credit unions are special because the efficiency with which they provide payment services directly benefits the economy. Important payment services are provided by typically Payment Clearing Association and the Central Bank of a country's transfer system. The Payment Clearing Association manages the clearing of checks, direct entry payments, ATMs, debit cards, and some high-value payments on a deferred net settlement system. Other payments clearing systems independent of this Payment Clearing Association include credit cards, the bill pay system for payment of bill using internet. The last one is denomination intermediation. Both money market and debt equity managed funds and unit trusts are special because they provide services relating to denomination intermediation. Many assets are sold in very large denomination, putting them out of reach of individual savers, or if purchased, resulting in savers holding highly undiversified asset portfolios. However, by buying shares in a managed fund along with other small investors, household savers overcome the constraints to buying assets imposed by large minimum denomination size. Such indirect access to these markets may allow small savers to generate higher returns on their portfolios as well. That's all of our discussion about other special services of financial institutions. Thank you for listening.